Hey everyone, welcome back to the Money Level Show where we think, act, and prosper. This channel focuses on changing financial trajectories and building legacies. I'm your host, Daryl Thomas. Happy to be back with you all. I've been going through a lot recently in terms of career changes and moving up in my professional career, as well as really diving into some sciences of communication and things of that nature. And so I have been leveling up, and that's why I've been off camera, but I have been posting an interview here and there. And so today I want to jump into a couple of articles. One article about Joe Biden allegedly bragging about the stock market's performance coming up into an election. There's been a lot of fear around whether we're going to have recession. We see the S&P making all-time highs. We're seeing a lot of the AI tech companies making all-time highs. We've seen companies like Chipotle and Costco going to significant highs. And so we want to take a look at what is Joe Biden saying about this. And then we also want to look at what Alden is saying about economic reacceleration, because she lays it out scientifically and how these systems are working against each other, but also how they are benefiting the stock market. So we're going to get into quite a few of those things today. And so I hope that you all are well. Be sure to drop a comment if you are tuning in with me today. Sorry, it's taken me a long time to get back with you all, but I have been doing my homework in other areas. And so I will continue to be consistent. And so thank you for supporting the channel. So I'm going to go ahead and kick the intro, and then we'll get back to it when I get back. All right.
Think. Act. And prosper. You are now tuned into the Money Level Show.
All right. If you have not watched my recent interview with Lobo Tigre, we talked in depth about the risk of recession. He still holds recession in his viewpoint in terms of hard landing or whatnot. And there is multiple other camps that are saying that we're going to get no recession, that we're going to get a soft landing, all of these different viewpoints that are conflicting with each other. And so we're going to just dive into some of that today, just to see what we can weed out and see how we can position ourselves for any possible outcome. And so let's get to it. So I'm gonna go ahead and share screen here with the first article. We're going to jump into Joe Biden being braggadocious. All right. So this week in Bidenomics, Dow 40,000. All right. So this was published on Friday recently. President Biden did something out of character recently. He bragged about the stock market. We know that this is it's almost like history repeating itself. I mean, President Trump, when he was president, he bragged about the stock market as well. The timing was good. On February 10th, Biden tweeted, "The stock market going strong is a sign of confidence in America's economy. Stocks have gone up even more since then, with the Dow Jones and S&P 500 indices hitting record highs and NASDAQ coming close. Wall Street analysts are now anticipating the Dow Jones Industrial Average hitting 40,000 for the first time ever, which would only take another 1.8% gain." So we see that Biden, he's tooting his own horn about the economy. He's saying, hey, the Dow Jones, the S&P 500, these are hitting all-time highs, and the NASDAQ is right behind them. Pretty much the issue here that I'm seeing, at least, is that the S&P 500 is held up by a very few amount of stocks. There's still a lot of stocks that are very cheap right now that have not seen significant increases in their share prices and things of that nature. I mean, I've showed a few to you all, like PayPal, Twilio. I mean, Twilio, just a really good tech company, pretty much just dumped. PayPal still been trading within the same range, over $50. And so there's some solid companies that are actually getting really good profits, and they're beating earnings and all of these things, but their share price is still very low. And so when you look at the S&P 500, it's held up by the most I mean, the biggest stocks out there where most of the retirement funds, most of the hedge funds, all this flow of capital was going to these specific Magnificent Seven stocks. I mean, well, Tesla took a dive down. I think Tesla will bounce back, but that's the reason why we're seeing these indices performing at all-time highs. That's a huge reason, because if you just look at the other companies, their performances haven't been as good. So with that being said, that means there's still a lot of opportunities in the market right now. All right, so let's jump back to it. There's nothing special about round numbers in any stock index, except they tend to capture public attention. Biden probably figures that's a good thing. Voters are giving him little to no credit for an economy with low employment, record job creation, and growth that is held up better than most economists expected. And I wonder why. People are feeling the impacts of inflation still, regardless of the numbers. People are still feeling the impacts of increased renting costs, increased housing costs, increased food costs, all of those different components. People are still feeling it, and they're wondering why people aren't on board, why voters aren't giving him the credit. So that's just my take on it. It's no secret why voters remain, I don't even know how to say that word, dyspeptic. Inflation has cut into their purchasing power. Okay, so they addressed what I just said. Inflation is down from its 2022 peak and is likely headed back to normal, yet Biden's approval ratings remains mirrored down the low point of his presidency. So Biden clearly needing some momentum in his re-election bid is stretching beyond his customary reach to convince voters the economy is doing well and he deserves another term. There's obvious risk to bragging about the stock market. For one, Biden fashions himself a working class hero, and ordinary Joes don't really want to hear about how wealthy investors are racking up gains. Second, stocks can turn on a dime and wreck your narrative, as President Donald Trump learned in 2020. That's true. Very true. Trump, while president, talked about the stock market on a weekly basis since it mostly went up during his first 3 years in office. He took credit and claimed his policies were responsible. He boasted repeatedly of stocks smashing one record after another and adding trillions of dollars in new wealth. Well, some of Trump's policies did have a huge impact on the stock market. I mean, the tax cuts, that was one of them. When Jerome Powell came out and got very tight in the market in 2018, President Trump criticized him, and we had the famous Powell pivot. And so then obviously when the pandemic hit, everything got hit, but the policies to vote for a huge amount of money printing pumped stocks to well past their all-time highs. So we can see that there was definitely some policies there that contributed to that. And so the story continues. Obviously, stocks plunged by 34% in 2 months, erasing most of the gains during Trump's term. And they're just going back and forth about Trump, Biden, blah, 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 blah. All right. Now let's get into the good stuff. Okay. So let's see what Lynn Alden has to say in her new newsletter. It's free. I've included the link in the description, so be sure to check that out. And this is about economic reacceleration. So this is free, so you can be sure to check it out. So an unstoppable force. What happens when an unstoppable force hits an immovable object? We find out which one of them isn't really unstoppable or immovable, is what happens. For nearly a year and a half, there have been opposing forces to loose fiscal policy and tight monetary policy playing out in the U.S. economy. And navigating the interaction of these forces has been a big part of our success or failure for investors during this period. So the forces were Fed's tightening, Fed's raising interest rates, Fed's quantitative tightening. Then you have fiscal spending money. So fiscal's been draining the reverse repo market, and they have been issuing T-bills to raise money, and they have continuously been stimulating the economy through their policies. So you have one doing the opposite of the other. So that's pretty much why she's laying out the unstoppable versus the immovable, like which one is actually unstoppable and which one is actually immovable. Fiscal policy, including the size of sovereign government deficits, who is on the receiving side of those deficits, whether those deficits are funded primarily with short duration or long duration government bonds. I talked about the T-bills. And then monetary policy, where they have the interest rates higher, they're still holding them up, and then they're also reducing their balance sheet. So she brings up President Trump publicly criticized Fed Chairman Powell on multiple occasions around 2018 for counteracting his administration's policies rather than being monetarily accommodative. So I just literally just brought it up. I have not read this yet. You all are going through this with me at the same time. It's a lot of information, and we're not going to get to all of it tonight. I'll tell you that right now. But just want to see what's going on in the macro scheme of things and what can we expect from the markets. So currently we see the markets are, obviously still pumping higher, and a lot of that is due to fiscal policy still stimulating the economy. So she goes through the history. This is the history from 2021 to 2022. And as an update, here in early 2024, the fiscal side is showing evidence of winning. The unstoppable force is moving the immovable object. Although we need to see if the data continues to confirm it in the months ahead, this chart doesn't show the whole picture, but it shows how the two forces impact liquidity, right? Liquidity drives everything. When we have a lot of liquidity, stock prices go higher, more people are investing, people have more money, funds have more money, things of that nature, right? And so that's how liquidity is important. Liquidity is heavily tied to Bitcoin as well. We know that Bitcoin runs significantly in a high liquidity environment. So this chart here refers to the fiscal versus the Fed's policies. As you can see, the assets, less eliminations from consolidation. This is Wednesday level, and this is the liabilities. And so, and other reserve balances. So we see that the fiscal policy, liquidity impacts, and central bank policy, liquidity impacts. So when this is down, right, and this is up, this means that the fiscal policy is losing and the Fed policy is winning. So then you get huge, well, no, actually, let me reword that. I actually misworded that. So this is central bank liquidity impacts. So this means that when the central banks are printing so much money, this is how much they were printing. This is how much they impacted the markets because they printed so much money from 2020 to 2021. And at that time, fiscal policy wasn't doing much. The Fed was doing all the printing. This continued, right? This continued. And then you had this point here where the Fed's liquidity started decreasing significantly in 2022. That's when rates started going up, quantitative tightening, and you still had fiscal liquidity impacts low, right? And so I don't know if you recall, October of 22, we had a huge drawdown in the markets. I mean, you had some of these stocks, Nvidia hit $100 and something, right? You had Meta hit $90. Those stocks that went off and just skyrocketed. Netflix hit low hundreds. So during this time, it was really bad because the Fed liquidity was down and the fiscal liquidity was down. So both of them were down. So the markets got impacted hugely, significantly. Now you have fiscal policy up, monetary policy down. So central banks are still doing their quantitative tightening and keeping the markets, keeping interest rates high, while the fiscal side continues to stimulate. And they're probably going to get more money from tax receipts at some point this year. Many people did clock in a lot of gains last year in terms, the market just really did really well last year for the most part. And so many people clock gains. And so when you look at tax receipts and people selling their shares and such, like the IR, I mean, not the IRS, but the government, the government should probably see a decent amount of money on their tax receipts. So that's another thing to factor in. So in which that means more money, more liquidity, more stimulation of the economy. While the Fed is looking at cutting rates at some point this year. So cutting rates, reducing quantitative tightening. That means they're not going to be selling as much bonds off of their balance sheet. They're going to slow that down significantly. So if that continues to happen, then you're going to see both of these, the fiscal and the Fed, continue to turn more. The Fed may go more neutral. I don't think they're going to necessarily, I don't know if they're going to buy bonds or whatnot, but the government is still going to be stimulating. So the government will have more money because they're not paying as much interest on their debt. Whenever the Fed drops rates, they're not going to drop rates significantly. It's not going to go from 5% to 0% in 1 year. However, they're going to start to reduce it, which is going to relieve some of the pressure on liquidity. So I think that, we could see a big run in the markets, this economic reacceleration. But let's go ahead and dive a little bit deeper into this article. So Lynn writes that history does show that between the two, the fiscal side almost always wins. It could be a bumpy ride at times, but as long as the country controls its own currency, when problems really hit the fan, they almost always print. So even if problems hit the fan, the Fed is going to print. So your money's safe, right? Your investments are safe because they are going to come to the rescue if it really hits the fan, right? When the Fed blinked, there's a difference between you and me. We both looked into the abyss, but when it looked back at us, you blinked. Batman. All right. The Federal Reserve Act mandates that the Fed must act in such a way to promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. While this technically refers to three different things, it is commonly referred to as the dual mandate: stable prices, maximum employment, and long-term interest rates. And the implicit in this dual mandate, triune mandate, is an additional shadow mandate, financial stability. So this is where the Fed has to ensure that the bond market and such is stable, that the banking sector is stable. So these are like the shadow mandates, right? The treasury market, the banking sector, things like that. And so as you see, March 2023, the Silicon Valley Bank went under. This was one of the largest banks failures in American history. And the Fed came out and bailed them out, right? They bailed them out. So the Fed is going to come to the rescue. So this is a long article, but I encourage you all to check it out. I'll put the link in the description below. We're just going to breeze through a couple other points. This is the ISM, Purchasing Managers Index. And so let's see what she's saying here. The Fed monetary policy is now feeding into even looser fiscal policy because their tools are designed to suppress lending-driven inflation rather than fiscal-driven inflation. And yet this cycle has been primarily defined by fiscal-driven inflation. Manufacturing PMIs, for example, are showing signs of economic reacceleration after a year and a half of deceleration. So usually when the PMI is negative, you get recession. It had a huge amount of deceleration, and now it's starting to tick back up. So this could mean that we may avoid a recession. Let's see. Then we got the leading economic index. So the U.S. LEI did not signal recession in January, as 6 out of 10 components contributed positively. So let's see. The Conference Board leading index has been flashing recessionary conditions for quite a while, but lately has been turning back up. So This is turning back up. I mean, it hasn't turned up much. I mean, we don't see a sharp increase like these numbers here, but we'll see what happens there. And then you have the month over month price inflation is not heading down as quickly as policymakers may like and remains above their target level. All right. So we see that we're still kind of in this we're seeing some better things happening, but we still kind of have these dynamics where we could still see recession. So we have to think about how to plan for both sides of the equation. I just want to so this is the investing implications. So let's look at what Lynn has to say here, and then we're going to transition from this article. So fiscal driven economic reacceleration does not necessarily mean that all asset prices will benefit, right? We talked about this earlier. There's still some stocks that are not benefiting. There's a select few that are benefiting, right? If you're watching with me, drop a comment in the comment section. Love to hear from you. Some sectors are very sensitive to interest rates and thus more negatively affected by tight monetary policy than they are assisted by loose fiscal policy, specifically any industry that uses a lot of debt related to its assets and cash flows, and especially with short or intermediate term durations for that debt, are very vulnerable to high interest rates. The commercial real estate industry and regional banks that lend to commercial real estate operators are in the main example of this now. So that sector still looks bad. And it could take a while for those high interest rates to fully impact those industries because it takes time for more and more of their debt, bank loans and corporate bonds that was issued years ago to mature and get refinanced at these higher rates. So while rates are still high, commercial real estate and things of that nature sectors can pretty much end up refinancing at higher rates on their loans. Other sectors are not very sensitive to interest rates. And so if they are directly or indirectly on the receiving side of these large fiscal deficits, then they are fundamentally on the right side of what is happening now. This includes profitable technology stocks currently reaching new all-time highs. If I show y'all stock, I had a friend, he made some a massive amount of money off of this particular stock. We'll go look at it here in a second. These AI stocks have just been going crazy. I can't even lie. They are fundamentally on the right side of what's happening now. This includes profitable technology stocks currently reaching new all-time highs, healthcare stocks currently reaching new all-time highs, defense and aerospace stocks currently reaching all-time highs, traveling and dining are at near all-time highs, and basically anything that upper middle class people and or retirees in general spend money on. So you can see that these sectors, these ETFs that represent these sectors, are at all-time highs. Okay. The ongoing strength of those sectors that are supported by fiscal deficits is directly harmful to the weaker sectors, such as commercial real estate, because those strong sectors keep the economy afloat and therefore keep the Federal Reserve from loosening monetary policy, much, if at all, for those weaker sectors. The cavalry is likely not coming to save commercial real estate, in other words. So this is her outlook. So unless something meaningfully changes, I expect to see continued strength in sectors that are not very sensitive to interest rates and continued weakness in sectors that are sensitive to interest rates, speaking in terms of their fundamentals, revenue, and earnings. With bigger than normal divergence between loose fiscal policy and tight monetary policy comes a bigger than normal performance gap between sectors that are more tightly correlated with fiscal policy and monetary policy, respectively. Now, to translate that economic outlook into a longer-term investment outlook, we need to consider a valuation overlay. Valuations can't tell us almost anything about what will happen over a given one-year period, but they have a lot of correlation regarding to what will likely happen over a 5-year period or more. So she still expects tech stocks to continue to perform quite well. But that's already baked into the price for most of those stocks with high valuations. And I'm not exactly jumping to buy various high value non-tech stocks like Costco. So this is Lynn Alden's valuation for Costco. It's like, so the blue line is the normal trajectory where the stock should be based on the valuation, somewhere close to $500. Costco is trading close to $750. So she's saying that it's overvalued. So the current PE is 49. The normal PE ratio would be around 27. Her preferred sector in terms of risk reward is the energy sector. Various energy producers with long-lived reserves and strong balance sheets are priced at very attractive levels and will stand to benefit if economic reacceleration continues. Here you're looking at Chevron, which is trading here around $150 or such. And if it was to be priced in according to its value, it should be at over $250. So yeah. So this is Leonardo's take on what's going to happen. And I think that for me, how I'm going to play this particular time is to continue to invest in what's been working. Commodities have still been doing significantly well. I have not been investing much into the base metal commodities. I think that, we haven't really seen like the full reacceleration back in terms of like infrastructure building and such. And when you look at these copper stocks and things of that nature, platinum and palladium, they're still kind of trading in the range. They got pummeled this past year. So I still haven't been investing there. Gold is pummeling as well, plummeted. And so I'm still investing in what's cheap, and mostly I'm focused on energy. Energy's still been pretty healthy in their staying at that $70 range and up. And so I'm just collecting dividends on most of those shares. Uranium had a significant pullback. I'm still positioning myself there. I think we're going to get another run up. And so commodities still are the place that I am, although I am still looking at some of the tech stocks. Like I mentioned earlier, PayPal and Twilio, those are two stocks that I've been holding on to. And, obviously some of the Bitcoin ETFs and such. And so, yeah, I think, right now I have a good balance in my portfolio. Please drop in the comments. What are you doing with your portfolio? Are you trading? Are you holding? Are you investing long-term, collecting dividends? Are you out of the market? Like, what are you doing? If you dropped it in the comment section below, that'd be great. And I just want to show this. This is how significant the tech AI craze has been, right? So I had a friend post about this stock, Super Microcomputer Inc. He posted about this on beginning of January. He bought a call option on it, and this stock was at about let's actually go to the chart. Here we go. This stock was at just look at it this past year, $80, $174 January of last year. And he bought a call option on it, and the stock ended up going up to $1,074. And he bought this call option back in December sometime when it was about $200 something, somewhere around here. And the stock hit $1,000 something. And so he made 20 grand, over 20 grand off of that one call option. And so this whole technology AI craze is like nothing to be played around with. They have been roaring really, really significantly. Nvidia up to $788. I told you all about my opportunity to buy them back when they hit $100. They hit a little under $100. I mean, in the back, in what, that was 2 years ago? Yeah, 2 years ago. Here was NVIDIA, $112. And I was too bearish. I was too bearish, saying like, oh, it's going down further. It's going down further. It's going down further. And so when you get into that echo chamber, you got to be very, very cautious and careful, because you can miss out on some significant gains. Right? I told y'all about this. $100. It's at $788 now. Meta. I remember Meta just got some bad news, started selling off quite significantly. It's at $484 now. I was buying Meta here. It hit $90. $90. Now it's at 400. It's over $400 now. Almost $500. So just be careful with when you get into these camps and these echo chambers and stuff. You have to like look at the other side of the argument and everything, and because you can miss out on some significant opportunities when you get too bearish or you get too bullish. So you want to have a balance, because ultimately we all want to make money, right? We all want to make money. And a way to do that is if you are not too caught into these echo chambers. So I don't see nobody commenting. I don't know what y'all doing over there, but love to hear from you. And let me know what you're doing with your portfolio this year. Love to hear some thoughts, ideas that I can process myself. And I'll see you all in the next video. All right. So y'all take care. Y'all have a blessed night wherever you're at. If maybe morning, if you're across the world, but you have a blessed day. If that's the case. And y'all take care. All right. Peace.